Now let's look at the second method of accounting, which is called as purchase method. Here we would also require the information that how much this company A has paid to company B to acquire company B. So let's say this company A has paid $1,000 to acquire company B. Okay, so with that assumption, let us start with the purchase method of accounting. Here it involves a couple of steps. Step 1 essentially says that whatever the assets and the liabilities of company B are, state them at fair value. So we need to rephrase these at fair market price. So we are trying to evaluate what is the book value, which is the fair book value of this company B. So let's look at that. So old and new, and let's go item by item and kind of define that. So let's say current asset here was 200 and the new market value, because as you may have already understood that balance sheet are actually carried at book value, so and the current market price could be really different. So we are trying to see what is the market price of this balance sheet B first. Current assets 200, it increased to 300. What about long term assets? Let's say increase this further to 700. Current liabilities, it was 100. Let's assume that this didn't change any. And the long term liabilities, though it was 300, it has changed to 400. So this is the market or the fair value. Now let's look at what is step 2. Step 2 is actually to find the book value of both old as well as new. So what is book value, by the way? Book value is basically shareholders' equity. And if you look at the old equation that we had about the balance sheet, assets is equal to liabilities plus equity. Here the equity is nothing but shareholders' equity, which we are talking about. So this equity is equal to A minus L. And this equity here is called as book value, and it is also known in industry parlance as something like net worth. So what we would like to do here is to calculate the book value of old as well as new. So here book value of old will be add this assets and subtract this liabilities. So this is 200 plus 600, this is 800, minus 100 minus 300, so this comes out to be 400, equal to the shareholders equity which was given on the balance sheet. Look at the new one, this comes out to be 1000, and here this needs to be subtracted, this is 500, so the balance amount is book value is 500 here. Step 3 is basically to find out the premium that company A had paid to company B. So what kind of a premium are we talking about here? This premium is nothing but the price that company A has paid to B. This is actually $1,000, and we compare the price which we have paid over and above the new book value. So how much was the price that we have paid? Price we have paid is $1,000, and the new book value or the fair market price of book value is $500. So we calculate the premium by subtracting these two, and the premium is $500 in this case, and this is nothing but called as goodwill, and this sits pretty on the balance sheet of company A. Please note that company B will cease to exist, so this goodwill will actually show that the company has paid a premium over and above their fair book value, and it goes as an asset on balance sheet of A. So let us try to now consolidate both of them and see how it will flow in the balance sheet. Let us now look at how the balance sheet of A plus B will look like when we use the purchase method of accounting. So I've just collated everything, company A balance sheet here, company B balance sheet, and what will be really important for us to note here is the new or the fair value of the balance sheet B. So let's try and consolidate this and kind of create the assets and the liabilities. assets of A plus B. So what happens in this transaction is that company A has actually paid company B $1,000. So let's assume that this was paid in cash. So here we would also assume that current assets actually were cash. So if company A has paid 1,000 as cash to company B, here the leftover would be nothing but 0. So what is happening is, if you want to consolidate, we'll add this up 1,000 plus we'll add this new value of current assets 300 minus 1,000, because this is the outflow which we have paid as cash. So the overall current assets will be 300 instead of 1,300. So please note, you have paid cash using your current assets which were there in your balance sheet. Okay. Now look at the long-term assets for this. This was 2,000 for company A. Here it was 600, but we are not interested in looking at the old book value. We'll look at the updated values. This is 700. This was 2,000 plus 700 here would give us 2,700. So this is the asset side. I'll just leave apart the goodwill for the time being. Let's try out and complete the liability side. So on the liability side, we have this current liability as 500 and the updated value is 100 itself. So current liability comes out to be 500 plus 100. This is 600. Okay. So let's look at the long-term liabilities. Long-term liabilities is 1,000 here and 400 here. So this is 1,000 plus 400. This is 1,400. And when we talk about the shareholders' equity, we do not consider the shareholders' equity of the company B, because we have purchased this. So what happens is only the shareholders' equity which is mentioned, that of company A, is actually kept here. So we write only 1,500. We don't add 400 as shareholders' equity because we have now purchased everything. So in this method of accounting, what we find is that the total liabilities comes out to be 600 plus 1,400 plus 1,500. This is 3,500. Now look at the assets and the liabilities side. On the asset side, we have 300 plus 2,700. This is actually 3,000, but on the liabilities side, it is 3,500. So the balance amount which actually will make assets equal to liabilities will be called as goodwill, because this is the premium that you have paid, and this goodwill is to an extent of 500. So what you'll see is that your assets will be equal to 3,500 here. So this is how you can actually go about creating the balance sheet of A plus B. So just to reiterate what we did now, we have paid cash to an extent of $1,000, and the assumption was that current assets actually had all cash elements. So you have immediately paid cash out of the current assets, and you were left with nothing. So that's why we added this 1,000 here and we deleted this 1,000 here. And when we added this plus B, which is the balance sheet of B, we didn't take the old book value, but we took the fair market value, which was 300. So we added this 300 here. Likewise, the long-term assets of 700 was added here. So we have added only the fair market values of the balance sheet B. So what we found was that the goodwill is basically the plug figure and also called as the premium. So that made the assets equal to the liabilities. So hope you understood this. Try to practice more in terms of doing some questions on this.